Bank of Israel Governor Professor Amir Yaron addressed the impact of the tariffs imposed by the United States on the Israeli economy this past weekend, warning that the risk to markets and investments in technology threatens growth. In an interview with Bloomberg TV, he said, Israel's main concerns today are the volatility in the markets and the slowdown in global trade. The bank governor added that while most Israeli exports focus on services, which so far remain outside the scope of the tariffs, the global economic uncertainty caused by the tariffs puts pressure on Israel's economy in a variety of ways. For example, Israeli pension funds are heavily invested in the stock market, and the technology industry is largely financed by American venture capital, Yaron explained. The more uncertainty harms these two areas, the more directly the Israeli economy is harmed. Due to the economic instability caused by the ongoing Gaza war, as of 2025, 15 to 20% of Israeli tech startups have relocated operations to Cyprus, Dubai, and Europe. The threat of tariffs on Israeli companies will likely lead more tech companies to at least partially relocate their operations to the United States, taking jobs and tax revenue with them. This is increasingly likely as approximately 60% of Israeli startups are funded by US-based investors. If Israel chooses to impose retaliatory tariffs on U.S. imports, such as Intel chips and Microsoft cloud services, it would disrupt local operations and further hamper Israel's tech ecosystem by driving up operating and supply costs, as well as extending lead times for components and services. The anticipated long-term effect of tariffs on the Israeli tech industry includes an erosion of competitiveness, a significant loss of U.S. market share to Indian, European, and American rivals in sectors like SaaS and cybersecurity. It would also cause a slowdown in innovation as reduced profits lead to less R&D spending, which in turn causes slower production cycles. The economic uncertainty of the ongoing Gaza war, compounded by the anticipated effect of U.S. tariffs on the Israeli economy, has already caused a brain drain in which skilled workers, especially in tech, emigrate due to prolonged instability. Israeli officials are reportedly continuing to work on plans to offer the Trump administration to reduce the level of tariffs imposed on Israel. However, initial attempts in late March to avoid the imposition of U.S. tariffs on Israel altogether by preemptively lifting tariffs on all U.S. imports from the U.S. to Israel failed. The Trump administration instead imposed a 17% tariff on all Israeli exports to the United States. This is higher than the 10% tariffs levied against goods from Saudi Arabia and the United Arab Emirates, but lower than the 20% tariffs levied against Jordanian goods and the 39% tariffs levied against Iraqi goods.